Welcome to Eldercare Illuminated, Torchlight's caregiving podcast. Eldercare Illuminated addresses the ins and outs and ups and downs of caring for your loved ones. Join us for interesting conversations with eldercare specialists, geriatric care managers, attorneys, and ordinary people with extraordinary caregiving experiences.
Welcome to this episode of Torchlight's Eldercare Illuminated podcast. I'm your host, Lenore Tracey, and today I'm happy to be speaking with long-term care insurance expert Eileen Tell. Eileen started working in long-term care way before it became so hip to be thinking about this. She had the foresight to see the gray tsunami approaching the country and think about how we were going to plan and care for our aging population. Eileen arguably knows more about long-term care insurance than just about anyone in the country, and even though it's the one insurance that can help pay for long-term care, it is not widely known in the public. Eileen, so glad you could join us and shed some light.
Thank you for having me. I never knew I worked in an area that was hip.
Oh, it is, and it's getting hipper by the moment. Before we get too far, can you give us an overview of long-term care, what it is, and what it isn't?
Certainly. Long-term care is the type of care that someone would need over an extended period of time or for the rest of their life in many cases, and this occurs when they're unable to care for themselves. It's typically needed as a result of an accident, an illness, or an injury, or it could be just the natural consequence of the aging process. Someone needs long-term care when they need help from another person to perform their everyday activities, things like bathing, dressing, using the toilet, caring for incontinence, or feeding yourself. And of course, we're all familiar with the needs that emerge when someone has Alzheimer's or dementia. In that case, someone might need help from another person in terms of supervision and support so that they don't harm themselves or another person. So that's long-term care. You also asked what it isn't, which is important. And I like to make the following distinctions. Long-term care is high touch. Someone else needs to physically help you do things. It's not high tech. It's hands-on help, most often provided in someone's home, not activities with high technology in a hospital setting or a doctor setting. Long-term care is also caring, not curing. Typically, we're talking about maintaining somebody's ability to function, not changing their situation so that they no longer need help. So hopefully those distinctions help someone understand what long-term care is and is not.
So it's really not medical in any way, shape, or form.
Correct.
It's really the help you need as a person to get through your day.
Correct. And typically, doctors are very seldom involved in long-term care needs. They're not the ones who know much about it. They don't see a patient exhibiting long-term care needs very often. It's the family that knows what the individual needs. When you go to the doctor, he or she comes in when you're already undressed and on the examination table. They don't know whether you were able to dress or undress yourself or get up on the table by yourself, or whether you know what day it is or who the president is or how confused you might be about certain things. But your family certainly knows.
Absolutely.
And families are typically have much more insight into what your deficits and needs are than the medical profession does. So it's really very much a family issue.
And it's a really difficult one. And so since this isn't a medical area, Medicare doesn't pay for long-term care, but people think that it does. It's very true that people's expectations are all off.
That's very true, and I would be the last one to criticize anybody who had that perception, because before I got in this field, that's exactly what I thought. Medicare is for people age 65 and older, and I assumed that that's when people would need long-term care, so of course Medicare would pay for it. And it's much more complicated than that. Medicare came into being in 1965, and at that point in time, average life expectancy was only about 70. People weren't living long enough to need much long-term care. And it was never designed to cover long-term care. It was designed specifically to pay for hospital and doctor care. as we've seen medical advances where people are living much longer. In fact, about a third of us will live into our 90s. Now many more people are needing long-term care, and they're needing it for longer because we're better at keeping people alive, whether they have disabilities or not. And so there's a growing need for long-term care, but nothing to pay for it except our own savings and income and long-term care. So we're all learning the hard way that Medicare doesn't pay for it because it wasn't designed to do so.
And I know people are surprised when you ask them, who do you think pays for long-term care? And then the answer is, you do. By and large, you pay for yourself. So I know that there is insurance that pays for long-term care, and that is called, not surprisingly, long-term care insurance. Not many people know about it. Why don't people know about it, and why, by and large, do they not have it?
Well, many people don't know about it because, as we just talked about, they think that other payment sources will pay for long-term care insurance. So they don't know there's a need for it because they think they're already covered by either Medicare, their health insurance, their HMO, disability insurance. Some people think that disability insurance will pay for long-term care needs. They don't think that they'll need a separate kind of insurance for that sort of need. And then a lot of people deny the need. They think it's something that isn't going to happen to them. It happens to somebody else. And it's natural to not want to think about it happening to you and to deny the thinking about it. And no one likes to plan for a negative event. So that's one reason. Also, long-term care insurance is a relatively new product. It first emerged in the 1970s, so it doesn't have the visibility or the product acceptance that life insurance and health insurance has. Health insurance is also something you know you're going to need every single year, even if it's just to get a physical and a flu shot and you're totally healthy. It's something you just know you need. And it's also easily bought at the workplace. Same thing for life and health insurance. People hand it to you, even if you have to pay for it. But for long-term care insurance, you have to go shopping on your own for it. And we'll talk later about where to find it, but people don't typically know how to find it. You don't just bump into it. And so that's what makes it much more difficult.
I want to say something that's going to sound really negative here, but everybody hates the insurance industry. We pay for health insurance, we pay for auto insurance, we pay for home insurance, we pay for life insurance. Some of us pay individually for disability insurance, and people do not think fondly of insurance, and they don't want to have to pay for another kind. So if you have this sort of combination of lack of knowledge about long-term care insurance and then perhaps the natural negative feelings about it, it's a bad combination.
No, it is really a difficult problem to solve because long-term care insurance has more I'll talk about this later, but has more consumer protections than any other kind of insurance I've seen. I got canceled from my homeowner's insurance for a mistake in not filling out a form that I never saw that my agent was supposed to send in. Something like that could never happen with long-term care insurance, so it's very heavily regulated. I know people hate insurance, and that is part of the reason that people just don't want to have another product that they have to have. They don't trust the government either, even though people love Medicare. They don't see that as a government program or insurance, and so it's an interesting psychological conundrum that prevents people from buying this product as much as they should.
It's a whole constellation of things that are contributing to this problem. So, Eileen, can you explain to us how long-term care insurance typically works?
Sure. Today's products are very flexible. They basically provide a pool of dollars. The person buying it decides how much financial protection they want. You can buy $100,000, $200,000, $300,000 worth of protection or more. And you can use those dollars to pay for care in a wide variety of settings. In your home, assisted living facility, and adult daycare, or nursing home care. The policies also cover things like respite care to give your family that might be helping you get care, to give them a break if they need some time off for a vacation or just a few days during the week. It also covers hospice care. And many plans today also will pay for devices or modifications to your home to help you be more independent in the home. And they will also pay for training if you have a family caregiver who feels that they would benefit from knowing how to safely care for you in a certain way. So those are valuable add-on benefits that they can provide. Something even more important than paying for care is many of today's policies have a geriatric care manager that can help the individual and their family understand exactly what the care needs of their loved one are and help them identify the best way to meet those care needs. So they will identify service providers and they'll define the frequency of the service that they think is appropriate. And it's not prescriptive, but they will make suggestions to you of how to best meet your care, and also, by the way, how to do so most cost effectively so that you can have that pool of dollars and preserve those benefits for as long as you might need care. So they can help you use your plan most cost effectively.
So is this a cash benefit when it comes time? So suppose you have the insurance and your loved one has the insurance and they have a stroke and they are now needing help with personal care, so the insurance comes into play. Are they getting cash or is the provider being paid? How does it actually work?
Okay, most of the time it's a reimbursement for the services that are received, and there might be a ceiling. It might be, we'll reimburse your services up to a dollar amount you've chosen. Let's just say, for argument's sake, $300 a day in a nursing home, and maybe the same for home care and home. Sometimes it is a cash payment, particularly for home care. It depends on the kind of policy you choose. You have the option to buy the kind of payment that you would prefer. When it is a reimbursement for services, when the provider is reimbursed, or typically that payment goes right to the provider. It's called assignment of benefits, very similar to how health insurance works, where you don't have to pay the nursing home and then wait to get reimbursed. You can assign that benefit so that the insurance company pays the nursing home or the home care agency or the assisted living facility directly.
So I have a friend whose parents had long-term care insurance. They were very lucky that they did. And somehow, maybe you can explain this or maybe not, they needed to move into an assisted living facility to meet the father's needs. And then he passed away, and somehow it was one policy that covered the two of them as a couple. Is that a possible thing? That's different from the way Medicare, for example, which just covers an individual for medical needs. But this was a policy that was an amount of care, I think, for either or both of them to use.
There are some companies that sell what's called a shared care rider that will provide coverage for both members of a couple, and it's designed one of two ways. You can have a pool of dollars that both members of the couple share, and there's no limit to how each of them can use that, let's just say $300,000. So one spouse can completely use it up, or the others, or they can split it evenly or just draw from it as they need. And then there's another model of shared care where it's kind of like a reserve tank. It sits off to the side. They each have their own coverage, but then maybe there's an extra $100,000 sitting off there, and each of them can draw from it as they need.
So I'm listening to you talk about 100,000, 200,000, 300,000, and just to clarify for our listeners, these numbers are actually not huge numbers. What does a nursing home cost for a month?
A nursing home, I think, is about $4,000, $5,000 a month. I'm not good at math in my head.
I think that's assisted living might be
right.
4,000 or 5,000. Around here, nursing home might be upwards of 10 to 12,000 a month.
That sounds about right.
Full nursing home care. So when you're saying $100,000 at $10,000 a month, you don't have a year's care yet.
Right.
That's huge.
Right. How the coverage is actually derived, they're not actually even nice round numbers like I'm using for this example. Typically, you decide how much benefit you want per day. Let's say nursing home care costs $400 where you are per day. So then you would take $400 and you would multiply times the amount of care you want. So let's say 4 years. So you'd multiply $400 times 4 years times 365 days a year, and then you would come up with your pool of dollars. That's how much coverage you have. And if I had a calculator, I would tell you exactly what that amount comes to, and that's your pool of dollars. But then, let's suppose you get care at home instead of a nursing home, and you spend $200 a day every day. That pool of dollars, instead of lasting 4 years, is going to last twice as long because you're spending half as much. And so you're going to get care for 8 years. Now let's suppose you're getting care at home and you're only getting it every other day because you have a family member who can provide care. Well, then you're going to stretch that to even longer than 8 years. That's going to last twice as long. So that's why this idea of a pool of dollars has so much flexibility. You can buy a set amount, and in that other example, if you're concerned about $100,000 not being very much, if you're not in a nursing home, or if you choose a nursing home that costs less than the going rate, you can stretch how long that lasts.
That's pretty interesting. So this is a different model. People need to understand that this is not like health insurance at all.
And that's why the care manager is so important, because he or she can help you find a lower cost option or help identify community-based services that might be available at no cost, or help support family caregivers so that they are available some days of the week so that you're not spending your insurance dollars too quickly if they see that you're going to have extended care needs.
So that makes sense. So can anybody buy long-term care insurance?
You have to be in reasonably good health to buy it, and like all insurance, you have to buy it before you need it. So you can't call up the fire insurance and get it while the barn is burning down, as they say.
Okay.
But the underwriting and the approval process for long-term care insurance is really different than what it would be for life or health insurance. They're looking at your physical functioning, your ability to do those activities of daily living, and your cognition. So mostly they're looking at conditions like Alzheimer's, dementia, Parkinson's, ALS, MS, and other rapidly progressive and degenerative conditions. And many other conditions would be evaluated based on how they're affecting your ability to function independently.
So once again, the idea is to look not so much at medical issues, but at issues that are going to cause a person not to be able to function day to day independently. I assume, and you can correct me if this is not correct, that it's cheaper for me to buy it when I'm 45 than when I'm 65. Can I still buy it when I'm 65?
You can. The upper age limit, I think, on most policies would be age 80. It would be difficult to buy at that age, both based on three things: affordability. Some companies have just a cutoff that they won't sell at that age, and also the likelihood that you would pass underwriting at that age is very small. So it's just not cost effective for either party to be looking at it at that age. The rates are based on your age when you enroll or apply, so it is less expensive the younger you buy it. The rates are designed to remain level. They will always be based on your age when you buy it. The company has a right to change the rates on a class basis, so they may, over time, if it's actuarially justified, request a rate increase to their Department of Insurance, and if it's justified based on claims experience for the whole class of insureds, then they may get an approval to a rate increase and make a rate increase based on the whole group, not any individual experience. And when they do that, you have the right to adjust your coverage so that you can maintain the premium rate you were paying or accept the increase. And there's some other choices that you can make. So you're never singled out for a rate increase based on your own experience, and you always have options to adjust your coverage so it's at a price point that you can afford.
Okay, that's also pretty interesting. You mentioned, I think earlier, that there were some different flavors of long-term care insurance and maybe some combination products. So if any of our listeners were to go out there and go shopping, what kinds of combos would they be looking at?
Sure. Well, the first flavor of the product that started was the traditional, or what I call standalone product. And it's called that because that's the only thing it paid for. It paid for long-term care needs when you had them. Now there are these combination products, as you say, where you can buy long-term care coverage in a rider that's attached to another product. And it can be a life insurance product or an annuity product. They're generally more expensive, and they're definitely more complicated. In other words, I will not do a podcast on those products because I still am not completely understanding them. But they have the advantage of being dual purpose. Whether you need long-term care or not, either way, you'll derive some benefit from that purchase. If you buy life insurance with a long-term care rider, you'll either get a death benefit for your heirs, you'll get long-term care benefits if you need them, or both. And then the same thing with the long-term care rider on an annuity. You'll get long-term care if you need it. You'll get a predictable stream of income in retirement, regardless of whether you need long-term care or not.
So just for anyone out there who's not sure, can you tell us what an annuity is?
An annuity is a product that you buy with a lump sum. You give $150,000, and then an insurance company or an entity that is allowed to sell annuities, and you can tell I'm not an expert, then has a contract with you by which they guarantee to pay you a stream of money. And typically you can have the contract specify either the amount that they will pay you monthly or annually, or the duration over which those payments will be made. And there's a contractual schedule of how that will be. And oftentimes they will continue after your death if the amount that's promised to be paid to you is defined as certain. So it's either time certain or amount certain. I believe those terms. It's all sort of coming back to me a little bit.
So it would go to your heirs. So people should definitely, if they're considering any of these products, be talking to a financial planner and someone who knows about annuities and long-term care insurance and all of the different ways that you can prepare to meet your financial needs as you get older. One of the things that it just reminded me of is that, and people may be familiar with this, is the difference between whole life insurance and term life insurance, where, if I understand it correctly, with whole life insurance, you're paying into it and you're going to get something back. It has a face value, let's put it that way, where term life insurance, you pay and you just get value, or your heirs get value, your beneficiaries get value when you die.
Correct.
Okay. Well, that was us talking about stuff we both know something, but not everything about. So where can people buy long-term care insurance? Where do you find it if you want it?
I would suggest as a start that people go to their Department of Insurance, the State Department of Insurance websites. Just Google that and then look up who sells long-term care insurance. They will have a list of who's allowed to sell in their state. And then look to see if they're companies that you have some kind of affinity with. Perhaps you have other products with these companies. Or call if you have an agent that you like doing business with and find out if they sell or if they know someone who does sell long-term care insurance. It's nice to start with someone you trust and know and that knows a lot about the product. I would work with someone who's been selling for a long time and has a product that they trust. So the Department of Insurance could give you some insights into who who is selling improved product in your state. And if people want, I can give them the names of the leading companies that are selling. There are about 11 companies that are selling the most long-term care insurance right now.
Why don't you just tell us maybe the top three?
Okay. The top three are Mutual of Omaha, Northwestern Mutual, and New York Life.
And those are the top three in terms
of how much they've sold this year.
And this is not an endorsement of any of them, just true. Household names you might be familiar with. This is something that if you're interested in it, you need to do your research for sure. I know that there is something called the Partnership Program, which was, I don't know how popular it is at this point or how much it's still available. Would you tell us a little bit about the Long-Term Care Partnership Program and what the states were trying to do?
Sure. There were 4 states that were part of the original partnership, and that's New York, Connecticut, California, and Indiana. And they designed a very specific kind of coverage, and it was what you would, as a shorthand, you would call short and fat coverage, which meant it had a higher benefit amount. Maybe it covered 2 or 3 years of coverage, and it had 5% compound inflation protection. So it was meant to be very comprehensive at the beginning of your care needs. And then if you needed more coverage after that, you would become eligible and the state would provide coverage through Medicaid, but you wouldn't have to meet the usual spend down requirements. So you wouldn't have to spend down all your assets. You would get some additional asset retention equal to the amount that your policy paid in benefits. So you'd get to keep more assets than you normally would for Medicaid. New York came up with a better version of that model that said you can keep all your assets and still be eligible for Medicaid. A number of states, probably about 28 states, later additionally came onto the partnership program. They have more flexibility. They typically offer partnership coverage if you have any plan that has inflation protection of a certain type based on your age, and it doesn't have to be as expensive as 5% compound inflation, and the requirements vary by the buyer's age. And they will also provide an easier pathway to Medicaid eligibility after you've used up your private coverage. You get to keep additional assets equal to the amount your private plan paid for. You still have to, important caveat to remember with these programs, you still have to meet the income and health requirements of Medicaid, and the services that you access on Medicaid may be different than the services that were covered under your private insurance plan. So Medicaid currently in most states does not cover care in an assisted living facility, and access to home care may be limited or subject to waiting lists. There also are fewer companies that sell partnership policies than sell long-term care insurance. So if you go on the Department of Insurance website, you'll see who's selling long-term care insurance, and then you'll see a shorter list of who's participating in the partnership program in that state. So they're still available.
I think that's still an interesting option that people should think about. For those of you who are not familiar with Medicaid, Medicaid does pay for long-term care for individuals who are poor. And I use that word with a little bit of discomfort, but it is designed to help people with few or no resources. So there is a very stringent income requirement and a very stringent resource requirement. So if someone who has some resources is interested in preserving some of those resources to leave to heirs, this is an option. And it was
correct.
The state trying to encourage people to save in this form, by way of buying insurance.
Right. If you could only afford 2 years of coverage, and you likely are going to use those 2 years perhaps entirely to get care at home, and then if you exhaust those 2 years, maybe it's less important to you that after 2 years of care at home, that Medicaid would kick in and your options might be more limited to facility care, but that might be where your care needs have evolved to at that point in time. And then you will be preserving assets for your heirs.
So that's a pretty interesting option, and I'm glad to hear that it's still available in those states that launch those programs. Just as a final question here, what should potential purchasers be aware of? What are the pitfalls or possible issues when they're looking at insurance policies, long-term care insurance policies?
Sure. Well, as I mentioned before, long-term care insurance is a very heavily regulated product. It includes a lot of really good consumer protections, more so than many other products. And so I think the biggest pitfall, quite frankly, is not looking into the product soon enough so that you can qualify for it and be able to afford it. I think another pitfall is either buying too much or too little coverage, or buying the wrong coverage that's not the right fit for you. I think it's always important to work with an agent that you trust, that really knows you, that is going to find out what your needs and objectives are. Everybody buys the insurance for a different reason. And so if I always tell people, if you're working with an agent and the agent is doing most of the talking, then find a different agent. They shouldn't be educating you or showing off how much they know and understand about the product. They should be finding out what your needs are. You should be doing most of the talking, telling them what you're worried about, why you want insurance, how you're going to use it, what your family situation is, and then they should be understanding that enough to design or recommend a product and features that best meet your needs. It's not about what they like to sell or prefer to sell or get better commissions on. It's about what you need that best fits for you. So I think that's really important. I think it's important to comparison shop. And they always say, if it sounds too good to be true, it probably is. At the time I bought, 25 years ago, I bought the most expensive product that there was because I just felt confident that that company was never going to raise rates, and they haven't. And now I'm paying less than any of my peers are for the coverage. So I think it's important to be skeptical if you see somebody that has lower rates, and buying from a company you trust. And be prepared. There may be rate increases, but it's still going to be less expensive than waiting and buying later. So I think buy coverage that anticipates that there may be rate increases, and know that you have the ability to reduce your coverage if there is a rate increase and still have coverage that you are comfortable with and meets your need. So I would almost buy a little bit richer coverage perhaps to start, knowing that you can always reduce your coverage later, but you can't increase coverage without going through a health screen again.
That sounds like good advice, and it sounds like the kind of shopping trip that I wouldn't do alone. I would take someone with me.
Absolutely.
Have another set of eyes and ears, maybe someone to take notes and kind of observe the interaction, and give you another perspective on the experience of working with the agent. Eileen, I want to thank you for sharing all this information. Insurance is something that typically frustrates people, but this sounds like it's worth exploring, especially with people living longer and with the high prevalence of dementia in the population of people over the age of 80. Thanks for listening to this episode of Eldercare Illuminated. If you want more information about long-term care insurance or to check whether your state has a partnership program, go to your state's Department of Insurance website. To find out, you can just Google those words, State Department of Insurance, and find your state. The more we learn about what to expect and how to deal with care needs and how to pay for them, the better our experiences as caregivers and care receivers will be. So thank you again.
You're very welcome. It's been a pleasure as always.
Everyone take care now, and we'll see you on the next episode of Torchlight's Eldercare Illuminated podcast.
Thanks for listening to Eldercare Illuminated, a Torchlight caregiving podcast. Find other episodes of Eldercare Illuminated on iTunes, Spreaker, and Podcast Go. If you're interested in bringing Torchlight Elder or any of Torchlight's other caregiving products to your workplace, please contact info@torchlight.care. That's info@torchlight.care.